Hello everyone, welcome back to this week's Technical Insights. Last Friday, US stocks rallied to kick off the month of November as Amazon led the Magnificent Seven in the earnings season and investors looked past a disappointing non-farm payroll report. The October non-farm payroll data that came out last Friday showed that the US economy added just 12,000 jobs in October, far below economists' estimate of 100,000. This marked the weakest level of job creation since December 2020. The unemployment rate held steady at 4.1%, in line with estimates. Traders did not react much to the non-farm payroll figures because the numbers was largely affected by the hurricanes and a labor strike by Boeing workers. So it's not going to be a representative number to the US Fed to pivot away from its 25 basis point rate cut this month. In fact, it is the US presidential election on 5th of November that has led to the elevated volatility in the markets. On Friday, the Dow Jones Index jumped 288 points or 0.69% to 42,052 points. Broad Index S&P 500 advanced 23 points or 0.41% to 5,728 points. Tech-heavy Nasdaq Composite Index added 144 points or 0.8% to finish at 18,239 points. The US indices had a negative week as we closed out the month of October. The Dow Jones Index dropped 0.15%, while the S&P 500 lost 1.37%. The Nasdaq Composite was the biggest loser for the week, tumbling 1.5%. Post-earnings slumps in Microsoft and Facebook Meta platform weighed on the indices and impacted the tech-focused Nasdaq the most. On the other hand, Amazon far outpaced the other Mag 7 stocks in the blue chip index and was up more than 6% for the week, and their shares surged 7% on Friday to close at its all-time high. Apple and Microsoft respectively were down 4% and more than 3% on the week. That caused the drag down in the US indices. Apple was also lower by 1.5% on Friday, despite the iPhone maker reporting a fiscal fourth quarter earnings and revenue beat. But net income slumped after Apple paid a one-time charge relating to a tax decision in Europe. Microsoft was trading nearly 2% higher on Friday, following a 6% drop on Thursday after the company issued a disappointing revenue forecast for its current quarter. Back in Asia, Hong Kong stock rose on Friday after property sales in China returned to growth for the first time this year, adding to strong evidence of economic stabilization in China. The Hang Seng Index advanced 189 points or 0.93% to 20,506 points, reducing the weekly loss to just 0.41%. The Hang Seng Tech Index, meanwhile, on Friday, fell 15 points or 0.34%, extending the week losses to 1.19%. Home sales by China 22 key property developers jumped 66% from a month earlier in October, according to China Real Estate Information Corp, and sales rose 2% from a year earlier. This was attributed to a strong improvement in home buyer sentiments due to the Chinese government's strong resolve on saving the property market, accelerating policy implementation, and launching more supportive policy measures to stimulate genuine demand. And property sales are expected to register a year-on-year growth in the fourth quarter this year and next year as well. This added optimism to an economic improvement after a number of stimulus measures that have been rolled out since September. The Chinese official PMI index last Thursday also showed that manufacturing sector ended 5 months of contraction in October, and a private PMI report on Friday also showed that the sector was in expansionary territory last month. So investors in China are getting really optimistic with a Chinese legislative meeting this week that may yield another highly anticipated fiscal stimulus. In Singapore, our STI Index ended the trading week on a negative note. Our benchmark index was down about 3 points or 0.1% on Friday. For the shorter trading week due to the Deepavali break, we lost about 38 points or 1.06%, ending at 3,555 points, extending the 1.29% drop that we saw last week for a second consecutive losing week. Year to date, the STI is now only slightly up below the 10% mark at 9.71%, and now 97 points away from the year-to-date high, or 2.73% away from the high of 3,652 points that we saw on the 23rd of September. Hong Kong Land was the biggest winner on our STI Index last Friday, ending up 3.94% or 17 US cents to US $4.48. Genting Singapore also performed very well, rising 1.2% or 1 cent to 84.5 cents. and could benefit from the optimism in Chinese economic improvement. So for this week's technical analysis, let's have a look at Genting Singapore. Last Friday, Genting share price rose just 1 cent or 1.2% to close at 84.5 cents. For the week, their share price rose about 2 cents or 2.42% for its first winning week in 4. Genting share price has been on a predominant downtrend for much of this year. The year-to-date high was seen on the 20th of February at $1.06. Recently, in August, we saw that Genting share price seems to have bottomed out after the formation of a double bottom at the year-to-date low of about 78 cents. Genting Singapore share price then recovered to a higher high of about 90 cents in early October and could have formed a higher low on the 25th of October at 82.5 cents. Looking at the indicators, the MACD indicator has been showing signs that the downtrend momentum is actually subsiding, resulting in the convergence of the MACD line towards the signal line. Both the MACD line and the signal line are also close to the zero baseline, and if both lines were to cross above the zero baseline in the MACD indicator, it could signal the start of another uptrend. The latest RSI reading on last Friday was at 49 points. It has also rebounded from a low of 33 points last week and has reached above the 14 days RSI moving average at a level of 43. If the RSI were to break above the 50-point baseline now, just 1 point away, the uptrend momentum that we saw last week may accelerate further. So with both the MACD indicator and the RSI signaling that Genting share price may be poised for a rebound, the recent low at 82.5 cents could be a good entry level. And with the lower bound of the Bollinger Band, which is the white line that you see here, at 81 cents, providing further support for accumulation. Traders may then target the red color line that you see here, which is the long-term 200 days moving average now at 88 cents as the first resistance level, with the recent high at the 90 cents in early October as the final resistance to take profit and go for an exit. And these are the updates that I have for you this week. I hope you find this information useful. So do remember to like, share, and subscribe to stay updated with the latest market movement. And I'll see you again next week in the next Technical Insight.